Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Got more information today, got some news releases or data releases we're going to go over. Just again, the housing market is still kind of trudging along here, and as I say, it's getting kind of boring, but I think we do see an end coming up in the future. We'll get into that in a little bit here. Today is the 21st of November. It's a Thursday before the week of Thanksgiving. Hope everyone's doing well, and if you're not already a subscriber, please help my channel grow. Click the subscribe button on the bottom right of the video. Thanks very much. So we're going to get into it right away now. NAR is National Association of Realtors, and they released today their October existing home sales data. So everything gets released this time of this time in the date of the month. Basically, Washington. Released from Washington, D.C. Existing home sales rose in October, a slight recovery from the decline seen in September, according to the National Association of Realtors. The four major regions were split last month, with the Midwest and the South seeing growth, and the Northeast and the West both reporting a drop in the sales. So existing home sales in October, I guess you could say they rose month to month 1.9%. So we saw a little bit of an uptick in sales, that's sales activity. Number of units sold with 5.46 million sales was the monthly activity. It was a 4.6% year-over-year increase in sales volume. Median sales price is just under $271,000. It's $270,900, which represents a 6.2% year-over-year increase. The amount of inventory that's in the marketplace right now, according to NAR, decreased from 4.3 months the previous in September to 3.9 months for October. So everyone sort of agrees that a balanced marketplace, which is enough homes for buyers and sellers are doing well, is about 6 months worth of supply. So we're dropped slightly below 4 months, which means we are kind of in a seller's market again. We're having a hard time getting out of that. So Lawrence Yun, NAR's chief economist, said sales increase is encouraging, and he expects added growth in the coming months. Historically, low interest rates, continuing job expansion, higher weekly earnings, and low mortgage rates are undoubtedly contributing to these higher numbers. That's what he said. We will likely continue to see sales climb as long as potential buyers are presented with an adequate supply of inventory. So, it's back to the whole supply and demand feature right now. So we're going to see prices just squeak up a little bit every month because of low demand. There's just not that much out there anymore in specific locations, and that's causing prices to rise. Simple supply and demand equation. So that's the scoop on that. When I look at the regional breakdown, in October, sales in the Northeast fell 1.4%, not changed from a year ago. Median price was up about almost 6% from the previous year. In the Midwest, sales increased 1.6%. And it was up 2.4% from a year ago. The median price was almost a 7% jump from a year ago. Homes in the South increased 4.4% month to month. That's up almost 8% from a year ago. Median price was up 6% from this time last year. In the West, the decline was 0.9%. That's 3.7% from a year ago, and the median price was $410,700, up almost 8% from a year ago. So even though we're seeing smaller increases, we're seeing some substantial price increases. Again, going back to the whole inventory thing, that's what we're faced with these days. If we want to get into a little more detail, and I'll post this information on the community tab section, the graphic that NAR puts out here. But for me, I go to a couple charts that they produce. Obviously, the South had 43% of the overall sales. The Midwest had 23%. The West 21%. The Northeast 13%. Obviously the Northeast kind of slows down with seasonality this time of year. Market conditions: first-time home buyers made up 31% of the sales, which is the same as this time last year. Sales to investors made up 14% of sales, which is a 1% drop year over year. Cash sales made up 19% of the sales, which was a drop from 23% from a year ago. And distressed sales, are REO sales, real estate owned, which means already foreclosed upon and owned or back into the lender inventory. So and short sales, that's what makes up distressed sales, were 2% of the marketplace, and that's down from 3% a year ago. And I can typically tell you, like I mentioned every month, that short sales make up actually less than 1% of the 2% here. So they're less than half of the distressed sales market. So the market that keeps getting hurt the most, essentially, or the segment, for me, really boils down to the under $100,000 market. There's obviously less sales there, 11% less sales from $0 to $100,000, and from $100,000 to $250,000, we're seeing almost a point less in sales. So that's where I call affordable housing. The 250 to 500K mark accounted for 13.3% of the sales, and you could say they actually went up. Sorry, that's a percent sales change. They increased by 13%. The 500 to 750K price range increased about 16.5%. So there you go. The rest, not too much going on. So that's our situation here. So once again, it's affordable housing. People are looking for the sub 250 homes, having a hard time finding them, and that's the segment that hurts the most, that needs the most inventory. So according to Remax, who puts out a national housing report, U.S. housing market experiences largest inventory decline since 2018. And they basically said America's home sales rose by 3.9%, marking the fourth month of the past 6 to post a year-over-year increase in sales, according to the Remax National Housing Report. So this is their own report, okay? Just realize that this is their report based on their information, and they look at 54 housing markets across the country. So according to them, the housing inventory fell 9% year-over-year across their 54 market report analysis. That's, again, according to this is a Remax housing report. And again, median price for a home was $254,000 in October, climbing 8.4% from last year. Going back to October 2013, last month's total now marks the highest annual increase for the month. So we can see that when individual brokerage firms or these real estate companies do their own analysis, they do differ from NAR, because NAR is looking at every sale that's reported on the MLS across the board from all their sources, whereas Remax here is just looking at Remax information in Remax marketplace. So just please keep that in mind. But again, the comment here is we don't have enough inventory. Yes, we already know that, and will prices continue to rise slightly if there's low inventory? Expectations are that they will. Even though they're plateauing, we're still going to see specific metro markets that will have price increases because of the lack of inventory. All right, renting a single family house has just got more expensive. This was out in CNBC today. More Americans find it harder to afford a home. Rental demand is soaring, especially for single family homes. The supply of rental homes is shrinking, and that continues to push rent prices higher, particularly on the lower end of the market. So clearly the homes that everybody can afford, and we have lack thereof, the sub 250, those are great single family rental type homes for investors. There's less out there, so of course what's going to happen if you're a landlord and you have a demand for a rental property, you're going to increase your rent rate. Simple as that. So we have people who are getting it by both sides. Rent is increasing, home prices are increasing. There seems to be no, I guess you could say, relief from people in the marketplace. Phoenix saw the biggest drop in vacancy rates, just 2.6% across the board. That pushed rent growth to 6.7% annually. Las Vegas wasn't far behind with 5% annual rent growth. Seattle rounded up the top three at 5.5% rent growth. Miami saw the lowest rent increase with just 1% annually. Now, I know that Miami, being a larger marketplace, has a lot of condos and apartments out for sale, a lot of overbuilding going on, or developers that overbuilt that they can't sell. And obviously now when they see the lowest rent increase, it's because they've got more product come in the marketplace. The comment here was the supply of for sale homes priced below $200,000 was down 13% annually in October, according to Realtor.com, which I mentioned, and the supply of cheaper rental homes is no better. The number of homes available for less than $1,250 per month of rent has dropped by 40% since 2013. So your typical average rent is just, it's where people need to be or want to be. That inventory is dropping. All right. Investors rushed into the marketplace, buying thousands of foreclosed properties at discount prices and turned them into rentals. And the number of single-family rental homes jumped 38% from 2010 to 2016, compared to with only a 3% rise in multifamily units. So, and I saw that because we were involved in the housing crisis. We were involved in working on short sales and doing deals in that time frame. And I can tell you that we sold a lot of our homes that we acquired or controlled to America Home for Rent, Waypoint, Blackstone, a couple other private funds, a couple other investors. So they bought a number of the homes that we were able to control. Now, how we controlled them was working with people who were distressed, financially distressed, working with short sales, and once we had the short sale kind of packaged up, we could move it to one of these funds or one of these investors, which is a good business, and we're going to continue to do that as time goes on right now. But the point there, that's where a lot of that's where the big market was, and there was only a 3% rise in multifamily. Now, fast forward from 2016 to where we are today, we see the multifamily market booming, increasing, whatever it is. I see a lot of activity in that space, see it every day, and we now, with the lack of inventory in single family housing, we see less of those being moved to hedge funds. So that's kind of the situation. So again, the big investors, the real estate investment trusts, hedge funds, other even smaller investors, they got into the game, still looking for homes. They're getting the deals that the average person can't, just because they can pay cash, they can move quickly. They're also buying at the foreclosure auction. They're also buying non-performing assets and loans from from Fannie and Freddie and other banks as well too. So they're controlling the paper, the note. They're also, in that way, they can control the homeowner and kind of direct or guide them as to where they want them to go, which is not necessarily a good thing, kind of underhanded, and they're working behind the scenes, and this way, that's how they're going to grab all the properties. It's only going to get worse until we sort of fight them and speak out against it, and actually look and try to go after that inventory ourselves. It's something I do, and that's what I profess to teach and to talk about, is the fact that there is the shadow inventory that's out there that is sitting there, and if we don't go after it, eventually it's going to go away. It's going to fall back into the REITs, the big hedge funds, the investors, and they'll turn them into rentals, and we'll never get a chance to get our hands on them. And subsequently, those homes won't hit the market, and they won't help push prices down either. So it's kind of this situation here, which seems like we have no way of getting out. We just have to get at that marketplace and do our best to intercept that deal or get our hands on the deal before it falls so far that it only goes to the lenders and the banks and the REITs. All right, that's how I look at these things. So again, you got to go out and you got to create your own inventory, which everybody can do if they just put their mind to it. So that's the scoop on that. And having said that, I missed this with respect to my last video because I have, if I record at 1 o'clock, if this comes out afterwards and I miss it, then I miss it and I can't talk about it, so I'm going to talk about it today. So there's an article, and I'll post it in the details section of the video on MarketWatch, at marketwatch.com. There's a guy out there, his name is Keith Juro. A lot of people who watch my videos, you've already commented, you've seen him on Real Vision and things like that. So Keith Juro talks about the mortgage meltdown. He writes a lot of articles on it, has his own website, does a lot of writing. Yeah, I think he writes exclusively for MarketWatch now. So he'll come out with a lot of opinions, op-ed articles on what's going on. So this one was, this home mortgage disaster is ready to punish the housing market. So this is authored by Keith Juro. And again, I actually like his articles, and I do follow him a little bit because I think he has a good grasp on what's going on in the industry with respect to the mortgages and the stuff that we don't really talk about in the industry. So there's a lot of stuff going on behind the scenes that's quietly happening and that we're not aware of, or a lot of people aren't aware of, that we just gloss over. Everybody feels that the marketplace is great, there's no issues there. That's not the case according to Keith, and I happen to agree with him. So it's about the cash out refis. They're obviously making a comeback, and he says they're gaining popularity again. And according to Freddie Mac's recent refinance report, basically 82% of all refinances in the final quarter of 2018 were cash out refis. Now, I've mentioned this before in previous videos, but I wanted to emphasize this again because it's back in the news. So 82% of all refis were cash out refis. Now, we know when people refinance, what do? Oh, you're looking for a better rate and term. If interest rates drop, which they have, or they've been up and down over the past year, but when interest rates drop, it opens up the refinance opportunity for more people to get a better rate to reduce their payments. But what that also does, it allows people to pull cash or equity out of their homes and do with it whatever they will and still have reasonable interest rates and reasonable payments. So you dip into your equity, you take a bit of it out. So the volume of cash out refis insured by the Federal Housing Administration, which is FHA, rose by 250% between 2013 and 2018. I look at 2013, we're coming out of we've hit the trough, 2010, 11, 12. We've just come out of the trough. We're working our way up in appreciation now. So between 2013 and 2018, 250%, I guess you could say, well, it rose by 250%, the cash out refis insured by FHA. All right. The agency said cash out refis represented 64% of all FHA insured refi transactions, which is quite a lot. And according also to CoreLogic, 76% of all FHA insured refinances in all of 2018 were cash out refis, the highest percentage in 2 decades. So you got to take a look at this. Now, for me, I go back that this is another sign that we're going to have problems ahead, and this is a major contributor to a future housing crash. So we're bubbled. I mean, from my perspective, we're bubbling, we're bubbled, we've peaked, we're peaking again. You know, we're basically holding sort of fast as far as values are concerned. We know some markets have already turned a little bit down. Some markets still growing a little bit, but they're growing slowly. The depreciating appreciation is going on, etc. But so what do people do? And this is kind of my concern, is that, well, if you don't want to sell your house because either you can't sell it, or if you sell it, you don't want to go buy another place because there's a lack of inventory, or that newfound equity you've earned after all these years is just going to go to some other person who's also earned their equity. So you're kind of locked in there. You're not really gaining traction. What do people do? Well, let's take our money out. Let's ride the market out and take our money out. And we'll play with it or do with it whatever we want with our money. Because, hey, it may still go up and we're going to be okay. Well, you never know what happens. And that's the key. So back in the last housing, we'll call it boom, bust, crash, crisis, as I always mention here, one of the major contributing factors was the amount of cash out refis that took place was a big component of having the market crash. So we're seeing this happen again. So as they mentioned, because of the terrible experience with the cash out refis during the last bubble collapse, FHA decided to lower the LTV on cash out refis. So really right now, your LTV, which is loan to value, is 80%. So that's what you're allowed, to basically have a mortgage. So as long as your new mortgage has an 80% loan to value, that's as high as you can go, and you can refinance and take some cash out, again, as long as you don't hit over that 80% LTV. That's down from 85% previously. And throughout the bubble years, their cash out refis were up to 95%. So there's some chaos going on there for sure. But again, this is a problem that we don't talk about because it's not interesting. Nobody wants to acknowledge this. So just realize that cash out refis have been on the rise, have risen, are still popular. And I've reported on this in subsequent videos or previous videos that when we see a lot of mortgage activity, like mortgage applications up or mortgages, stuff happening, it's the refi business, and when we delve deeper, it's a lot of the cash out refi. So less purchase mortgages, but more cash out refi mortgages happening, and people are doing it. As simple as that. So how I look at this going, why bubble era, and he further goes and talks about why bubble era cash out refis are still a big concern. Well, if you think back in time, almost 10 million cash out refis were originated in the wildest bubble years of 2004 to 2007. And I guess you could say mortgage servicers nationwide have been extremely reluctant to foreclose on long-term deadbeats since 2012. So there's a lot of people who did refis that maybe aren't paying or have had a lot of problems. They haven't foreclosed on yet. Why? Because of potential recovery. Maybe they haven't recovered from what they took out to where the home value is now. So they're just the lenders, the servicers, letting them ride it out, for whatever reason. So there's a lot going on that problems that haven't even hit the market as of yet. So another enormous problem is the modified mortgages that have already redefaulted one or more times. So close to 2/3 of all subprime bubble era mortgages had already been modified by 2015. That's kind of interesting, because if you took out a mortgage and modified would have been you stopped paying, but you were able to at least get it together, and the lender was able to modify your mortgage, which was good. But guess what? These mortgages are re-defaulting right now. And this is what I see. The situation still exists. The origination of new cash-out refis have been soaring for the past 5 years. Lenders and borrowers alike apparently have learned little from bubble era excesses and subsequent crash. With home prices continuing to weaken, many of these homeowners may soon find themselves underwater or nearly so. So as I mentioned, if you take out a cash out refi at the peak of the market and you now have maybe a 5 or 10% drop, if you do the numbers on selling the house, closing costs, maybe some commissions, with your refi, you could be underwater. Now your house stuck. So how do you do that? Are you going to bring money to the table to close? If not, you got to do a short sale, or you got to ride it out, and who knows what's going to happen. So be aware that this is the situation we're finding ourselves in. So lenders are going to lend, people are going to take money out, and I do believe that's the problem, is that with low inventory and prices still remaining relatively high, if I sell my home today, I don't feel comfortable taking what I've earned and then buying another property. I'm not coming out ahead. It's not like I made $100,000 but put 50 in my pocket because I bought a new place that was cheaper or more cost effective. No, that 100 went into my next place, whatever that is, just because those prices have risen as well too. So it's kind of like you drag and tag along. Your property went up, but so did the guy next door. And if you want to buy that property, you're going to pay a premium for it as well too. So having said that, if I can't buy and move or relocate, my next best option is to cash out refi, which will cause subsequent problems down the road. So that's my thought on that, but it's always a good article. I like to listen to what he has to say. I like to read what he has to say. I do believe he's right on the money with respect to what's going on. There's a lot of history of mortgages, a lot of history of mortgage delinquencies and how they were taken care of, and all these issues. What's interesting, and he's a proponent of this as well, which I do agree with. When we take a look at the housing recovery, if you can call it that, it's not because we had housing prices that rose, and why did they rise? It's not because of wage growth. We've proven, and everyone talks about it. Even NAR and CoreLogic, all the people that are out there, they do agree and state that housing prices have gone up, but wage growth has not kept up with housing price increases. The reason why we've had the recovery, if you like to call it that, and housing price growth is because of the controlled inventory. So when all these homes were foreclosed upon back in the last crisis, lenders held on to them, they sold them to hedge funds who held on to them. They weren't put back on the marketplace as new homes that people could purchase. They were controlled, and these buyers that bought non-performing loans or assets, etc., REOs, whatever that they did, they're converted into rental property. So these homes that they bought at discounts or at good prices didn't come back in the marketplace at those discounts and good prices offered to John Q. Public. Basically, it went into becoming rental properties for big institutional investors. That's the way it goes, folks. So that's what happens, and looks like it may happen again if this all keeps up here. So again, to summarize today's comments, it's supply and demand. We had a modest increase month over month with sales. That's the big issue. Inventory, obviously, demand has outpaced supply. We'll continue to have issues unless we can find new inventory sources, which I can tell you guys I know where that source is. You just got to contact me. I'll show you how to get your hands on them. So thank you for the likes, thank you for the views, thank you for the comments. Please share my video with your friends and family and colleagues. Helps my channel grow. If you're not already a subscriber, please click the subscribe button. I would really appreciate that. If you'd like more information on the real estate market, I have a report, housingbubble2.com. Please go to the site, put in your email address. It'll give you access to it, and you can download it right there. If you'd like more information on real estate, drop me a line. My email's been popping up on the monitor right here. I do have real estate training courses, never pay retail, and I also have my advanced short sale course, which you'll find very interesting, and I think it will solve a lot of problems for a lot of people as time goes on and there's less and less inventory, because that's where there is inventory in that marketplace. So everybody, take care, have a good weekend. We'll make sure we speak with you before the Thanksgiving holiday.